You're gonna learn by watching this video how the 1% manage their money and how you can do the exact same. And when I started researching this video, I was kind of disappointed by the different videos out there about teaching you how to manage your money like the 1%. Maybe the top 10 or 20%, that's how they manage their money, but I really wanted to know, what was it about the 1%? What did they do differently? So I did a lot of research and figured out exactly step by step what people are doing. And by the end of this, you're gonna have an idea of how to set yourself up to be more like the 1%, where you can invest and you can be strategic with the decisions that you're making on a daily basis. Whether you're making $10,000 a year or $1 million a year, it doesn't really matter. What we're gonna see is how can you work towards being in the 1%. You're not gonna get there today. You're probably not gonna get there anytime in the next year or two. But with consistency and discipline, I'm gonna show you what it takes to get closer towards that 1%. Even if you never get there, even if you're just in the top 10%, we're gonna be looking at all of that during this video. And like I said, when I started this, I wanted to know who makes up the 1%. Is it gonna be entrepreneurs? Is it gonna be athletes, inheritors? Maybe it's gonna be artists or doctors, lawyers, engineers, something like that. But I wanted to know, how do the 1% manage their money? Well, there's two different ways that we can say who are actually in the 1%. The first way is, like, we could just look at their income. Are you in the top 1% of earners in the United States? And the reason that we're not going to go into depth as much when it comes to that is because income is kind of a fickle thing. You think about someone like Mike Tyson. Mike Tyson, he went from having $400 million, being worth $400 million, to being completely bankrupt. It doesn't really matter how much income you have coming in if you don't know how to manage it. But for those who are wondering, to be in the top 1% in the United States, the Visual Capitalist has this great graph, and you can tell basically the more people there are in the state, the more likelihood that you're going to have some who do really, really well and some who do not do near as well. So you think California, Washington, New York, Texas, some of the states who have a higher population tend to be those who also have the higher earners in them as well. What we're going to be spending the majority of time today focused on is going to be your net worth. Because I don't care if you make $500,000 a year. If you can only keep $5,000 of that, you're going to be behind compared to the person that is making $50,000 a year and saving $10,000. What matters more is how you manage your money, and over time, is your net worth growing? That's what we're going to look at. What does it take to be in the top 1% of net worth? Because I want you guys to be like Peter Thiel, who put $2,000, he turned $2,000 into $5 billion in a Roth IRA. And a Roth IRA, as you know, means that you get to pull that money out tax-free. So $2,000 into $5 billion is something that we have more opportunity over, versus some of you might not ever hit the income that's needed, on average $700,000 in order to be in the top 1%. But through net worth over time and actually being a good steward of your money, you can be a lot closer towards that 1%. So how much actually is the 1%? Well, the 1% in the United States, if you want to be in the top 10%, you're looking about having a net worth of $1.9 million. To be in the top 2%, $8 million, top 1%, if you have more than $13.666 million in net worth, you would be considered the top 1%. Now, if we look at it graphed out, I'm going to show you two different graphs. One of them being, here's the top 1% in the teal, and then you've got the top 10% in the gray. And you see this little purple down here? Yeah, that's the bottom 50% of the United States. Here's another way to look at it. The majority of the wealth comes from the top 1%, then the top 10%, and then the next 40% is about the same as the top 10%, but down here you've got the bottom 50%. One more graph just to drive it home. We've got the US wealth distributed, where you can see that a minority brings in a lot of money. The next biggest section is 65.2 million households bring in about 106, almost $107 trillion. And the bottom 60, almost 7 trillion households bring in only $4 trillion. That's their net worth. All right, zooming out, we are going to look at net worths. Now, there's two different investments that most people think of when they think of, where can I invest my money to watch it grow? One is going to be the stock market, and the other is going to be real estate. So we're going to look at both. Starting with the stock market, we're going to look at the growth over the last, since about 1990. All right, you can see the trend where it definitely had a dip in 2000 with the dot-com bust, 2008, same thing, but you can see it rebounded there, it's steadily come back up, 2020 scare, all that. Then real estate here is gonna look similar for sure. There's no dot-com bust, but there's definitely some dragged out here in 2008, 2009, and this is where we're at as of today. Now, what we're going to look at is how do people's net worth compare, and then we're going to compare all of them side by side. But the top 1%, you can see that they are invested. Theirs kind of looks like the stock market graph, and it's continually up and to the right. Top 10%, their graph looks almost identical, right? Maybe a little bit less volatile. Now, one thing to point out is that the assets are not the same. You can see over here, this is $50 trillion that the top 1% have in their possession in terms of net worth. The top 10% have almost $60 trillion, and then the bottom 50%. Now, this is an interesting graph. What do you think this is going to be? So the bottom 50% is actually only about $4 trillion. And the most interesting thing is this doesn't really follow the stock market, nor does it even really follow the real estate. In a way, it kind of does. But when you compare all of them side by side, I was really just asking myself, why is there this big lull, this big dip here when it comes to the blue line, which again is the bottom 50%? And the reason being, I chalked it up to 5 different reasons, is one, maybe they sold low, the bottom 50%. They panic sold their stocks in 2008, 2009, 2010, or their homes during the crash of this time. Many of them just lost their homes straight up. They were foreclosed upon, and many of them took on debt. They relied on credit cards just to survive, and a lot of them didn't reinvest. Okay, so these are things that you can be thinking of as when the next dip happens, because we know it's going to. These are some things that you can think not to do. But many of them missed a 10-year bull run simply because they didn't invest. And then also, a lot of them just ran out of jobs. They didn't have any income. They didn't have any access to capital, whereas people in the top 10%, top 1% still had money that they could work with and put to work. They didn't have to worry about selling because they were in a better position financially, which is what I want for you as well. Now, this next chart is probably the most interesting find that I found in all of my research. Now, there's still more research to come, especially when it comes to where to invest, but this gives a wonderful breakdown, whether it's real estate or whether it's stocks or vehicles or life insurance, all of that. This is from the Financial Samurai is where I found this, and they broke down different categories based on net worth level. And it's probably one of the most interesting things that I found. So I'm going to show you that right now. All right, so now here's what it looks like. They broke these down into different assets, business interests, stocks, vehicles, primary residence, all of that. And then also the net worth tier from 10K, 100K, million up, right? And so what I wanted to show you, now if you're in the 10K net worth section, you can see that you do have some liquid generally. Primary residence makes up quite a bit of your net worth, followed by vehicles. Then you're talking retirement or pension, maybe some life insurance, a little bit of real estate. Once you move into the $100,000, you can see actually your house takes up even quite a bit more. Vehicles go down significantly. And then everything else, retirement, adds a little bit. Once you're at $1 million, here's where it gets interesting. Look at the vehicle. The vehicle goes from what, almost 25% as a portion of your assets into maybe 5, maybe less than 5. And then same with the residence, primary residence, it actually goes down pretty significantly. Then you've got business interest, that spikes up tremendously over $1 million. This hopefully is going to give you a really good idea is as to if you want to be closer towards that $1 million range or $10 million plus, what to do and then what not to do, right? Prime case in point that vehicles are probably going to be, if you want to be in that lower net worth tier level when it's like less than $10,000, go ahead and own yourself a lot of vehicles. If you want to be more towards the $1 million plus, look at where they're at with the vehicles. Now, when you're in a $10 million net worth level, their vehicles are almost nuts. Their business interests are significant. And then $100 million, their business interests make up almost 46% of their net worth, and 10% of that being towards stocks. Another 10% or even a little bit more is going to go towards mutual fund. And then finally, for those who are in the $1 billion range, you can see that their net worth is primarily made up of business interest, followed by stocks, then maybe some mutual fund, a little bit of real estate. But what I want you to take away from this graph is that people in a higher tier level have different priorities. So if you are striving to get to that next level, think about how can I make more of my money and my time go towards, say, business interest or learning about stocks or mutual funds, and less about the car that you drive or the house that you own, because these are not major factors when it comes to net worth for higher individuals. And again, that's why this is probably one of the most interesting graphs that I found while doing this research. But now I want to take it over here and I want to know what exactly is it that makes the 1% different. And I've chalked it up to 3 different things, starting with the savings rate. All right. Now, when it comes to savings rate is when you take what you're saving or investing and then dividing that by your income. So if you make $100,000 and you're saving $15,000 of that, that's a 15% savings rate. So when it comes to the 1%, what they're doing is they have a belief that we save first for ourselves and you spend what's left over. What many people do is they take their income, then they factor out all their expenses, and then anything that's left over goes towards investing or towards savings. The 1% and the 10%, I'll tell you this right now, they flip that. They say I'm saving and I'm paying myself first, and then anything else beyond that is going to go towards expenses. Number 2, the people who are in the top 10%, they're saving 20 to 30% of their income, and in the top 1%, they're saving closer to 40 and 60%. And they're tracking their net worth, not just their income. And then finally, they're avoiding lifestyle creep and they're just automating everything to the point so they don't even have to think about it. And just to go a little bit deeper on this, point 1, both groups are using the same formula where they're actually taking their income, they're subtracting their savings first, and then everything else that they get to expend. They're flipping the common script. And point number 2, they're saving 20% to even 30% of their income. They're treating savings more as a fixed cost, kind of like rent, where it's just an afterthought. And the top 1%, they're even saving more sometimes, especially early on. And they're trying to live on even as little as 10 to 20%, while meanwhile, they're aggressively building assets. Number 4, they're focusing on net worth growth, not just amount of income that's coming in, and they're tracking it, whether it's quarterly, some even do it monthly. I personally do it monthly because that's how I like to do it. And the whole goal is optimizing for long-term wealth, not necessarily what you can make right now. And then number 5, they're avoiding that lifestyle creep. They're automating their savings. They're making sure that it comes out before they even have a chance to think about it. The second difference about what makes the 1% different is that they have specialized skill and income. Now, I'm not going to lie, there's definitely a truth to be told that higher income earners definitely have a leg up, especially when it comes to building net worth. But what do I mean by when they have specialized skill? Well, first off, they're focused on niche skill mastery. And what I mean by that is that they're prioritizing skill stack that help them in the marketplace, that help them to earn an income to their benefit. And then number 2, they're problem solving more at scale, right? They're not just working hard, but they're actually using leverage. They're using their skills in roles that are going to be more scalable, whether it's going to be commission or sales, consulting, ownership, right? And then number 3, they're skill stacking for even more leverage. So top 10% of people are building their wealth, they're building their income through mastery of one particular skill, or maybe 2 particular skills, but they're not trying to learn everything and be everything to everyone. They're learning skills that they can stack to leverage themselves and then often reaching $150,000, $300,000 by just refining that one skill over time. Number 4 is they're actually moving into more equity or ownership roles, right? The top 1% are earning $600,000, even $700,000 by solving problems that are not easy. They're really difficult, and they're doing so at scale. You're thinking about founders, surgeons, engineers, advisors that are elite, right? And then number 5 you're relentlessly learning and positioning yourself to be better. So you're seeing income as more of a byproduct of what the market values at. And you are continually investing in learning and coaching and positioning. So that's something that you can do to kind of improve or specialize on your skills and optimize the income that you have. And then the third thing that makes the 1% different, and this is what everybody wants to know, is how can you be more strategic in your investments? So again, from the Financial Samurai, I found 5 different categories that the elite are investing in when it comes to what's going to get them the best return over the next 5, 10, 20 years. And these 5 categories are broken down as follows. Number 1 is going to be artificial intelligence and machine learning, right? And just to give you a little bit of information, I'm not going to read everything, but you can see that artificial intelligence and machine learning is expected to grow by about 30% annually over the next 5 to 10 years. Number 2, we've got modern data infrastructure, and modern data infrastructure is kind of the invisible backbone of AI, right? Again, you can see that it's expected to grow about 25% compounded annual growth. Number 3, we're looking into development operations or DevOps, right? And cloud engineering. These roles are booming and they're enabling super fast cyber software development across trillion-dollar ecosystems. The 4th strategic investment that they're looking for is financial technology, right? And so again, you can read a little bit more on this if you would like, but fintech is another major area that people who are in the top 1%, top 10% are looking into. And then number 5, they're looking at real estate and property technology. Again, you can read this a little bit more if you want. Expected to go 20 to 30% compounded annual growth. And that's really how the 1% are making their money, how they're making their money work for them in a way that it's not just about earning more income, it's about being smarter with the income that you earn. And so go back, rewatch some of the parts that you found helpful, skip the parts that you didn't, but ultimately all of this you can boil down to, are you an owner? Are you leveraging your time, leveraging your money, right? What are you doing that's setting yourself apart? Where's your savings rate at? I made a whole video on that already about finding your savings rate. These are all things that you can be thinking through today, even if you're not exactly where you want to be. If you have an idea in mind of, hey, I want to take it to this next level, go ahead and look at that next level and look at what they're doing and then replicate that. And if you want bite-sized pieces of financial tips that you can take with you and actually learn and grow and digest, go ahead and sign up for the 1 Minute Money newsletter. It's down below. Subscribe to the channel if you're not already, and we'll see you in the next video.